to report to you now. Some of the changes relate to terminology. What used to be called a reportable condition is now a significant deficiency or control deficiency. But they also lower the threshold of what we were required to report to you. Things that weren't required to be reported before, we are required to report to you. So there's something that may not be in a management letter now that in previous years that would be now. The tone of the new standards is really to heighten management's awareness that you're ultimately responsible for the financial statements and the internal controls of the town. Over the years, the internal control procedures have kind of just grown, either by statute or by someone in town saying, hey, something's not working, let's do some reconciling procedures here, or maybe we should look at this, or even through management letter comments that we've recommended. And you do have good control procedures. However, the standard setting board believes that procedures should be established by management, that they should be documented, and this is a key part of it, that they want you to document all your control procedures, and to be periodically evaluated. And I think they're right. I think that these control procedures really are management's control and shouldn't be subject to who's sitting in the town accountant's chair or who's sitting in the treasurer's chair. It should be what you people think is important in the internal controls. A new town accountant could come in and say, I don't really think it's important to reconcile cash every month. We could do it every couple months, or reconcile receivables every 6 months. That'll cover us. Or some expenditures don't have to go through the warrant process. We don't have to have it signed by you first. And unless you have something documented that says this is what the management of the town thinks is important internal controls, it's kind of subject to whoever's sitting in the chairs in your offices. So they also believe another big component of the new standards is they want management, and when I say management, I mean Greg, Joe, yourselves, the upper level management people, to make risk assessments. So where can material fraud take place, and what are we doing about it? They want discussions about these things periodically. So we recommend that the town do some internal control documents for the major cycles, payroll, expenditures, revenues, accounts receivables, and just kind of do a step-by-step narrative, have different people do a step-by-step narrative of what they do and what the controls are, and bring it to you and update it periodically, and ask the question, where is our risk, and on these different cycles. So that's a new standard, and it's not something you have to do every year, but something that you should look back on every once in a while and say, what's going on at the golf course, at the school lunch. You have real good controls. Some of the big dollars you might think would be have a high risk, but the real estate taxes, you collect big money on that, but it's committed by the assessors, it's collected by the collectors, it's reconciled by the accountant's office. So there's a good internal control structure in there. And state aid's big numbers, but you got a budget amount. The revenue gets deposited through an electronic transfer. If it doesn't match the budget, you'll know something's up. So it's really you don't have material fraud risk on the larger numbers. It's probably more the cash collecting department. So although it might not be material to the financial statements, in municipals, even a $5,000 amount is material to the public interest at least. The next comment has to do with reconciling procedures. This town accountant's office, Joe, reconciles the accounts receivable to the detailed list in the collector's office every month. So he knows by doing that there's $100,000 outstanding in real estate, that there's a list of people that support that $100,000, and so he's pretty comfortable that his number in his ledger is correct. They also perform procedures to reconcile cash, but they reconcile cash to the treasurer collector's cash book, which it's almost like check registers for all their accounts. And as a result, they're looking at the cash book. They're not looking at bank statements. They're not really sure that $1 million number on that cash book is actually supported by a bank statement, a reconciled bank account. So, I mean, it is. You don't have to worry about that. But from an internal control standpoint, you don't know that. You're just reconciling to a piece of a spreadsheet, actually. So historically, most municipalities do it that way. They relied on their audit firms to do, on June 30th, to reconcile the cash book to the bank statements, ensure that the treasurer has support, have bank accounts that support them. And we even said that to them. Over it's been for 20 years. We've even said, you know what, we do that. Don't worry about it. But these new standards jumped up again and said, if you can't consider your audit firm a part of your internal control structure, so that knocks us out of the box. So, or else we have to put a finding in. So that's why this finding is in. So what I recommend that to continue doing the same thing that they've always done, that just once or twice a year, that they, when they're reconciling cash, that they look at the bank statements and the reconciling items and the deposits and transits and the outstanding checklist, and make sure that the bank's the cash book is supported by actual cash.
Can I ask a question?
Joe, go
Excuse
ahead.
me, if I could, now, did you say that that change has to be made because of a new law that's just come into effect?
Well, it's probably good, it's a good internal control, but it's probably not something I would have put into the report. It's something, the new standards are saying, because
A
we
new
used to do
standard,
the
I should have used the word standard.
Yeah, the new
not law.
standards say that, they used to rely on us to make sure that the cash was
Yeah,
supported.
and that changed this year?
Yeah, and this year it should have, what it's saying, you can't use your audit form
Okay.
as part of your internal control
Okay, I understand,
structure.
thank you.
As you can see, Joe's taking
Yeah,
action.
yep,
on that already.
yep.
Yeah. The next department has to do with procurement. We're eventually able to satisfy ourselves on all the procurement information. It's just that a lot of the documents were all out on a departmental level, and took a lot of time and effort to try to pull them all together. One of the focuses of the Procurement Act is to try to centralize the documentation, and so that you can do more auditing with less work. So it took us a long time to try to get certain files on it. So we just hope that you can that procurement officer will centralize and follow. I don't know if it's going to be Joe or if it's Greg that's procurement, but gets copies of all the newspaper bids and the newspaper ads and the bids, and has the contracts all in a more central location. Next comment has to do with town meeting. At your annual town meeting, sometimes you vote in what is it, in May? April town meeting. Sometimes you include some votes that relate to the current fiscal year in there, so as well as the next fiscal year. And that kind of complicates the preparation of the recap sheet and when Joe closes the books. The recap sheet has to have town meeting votes broken down by date and by fiscal year. And so Barbara will have to pull apart the votes, because there's articles in there that relate to the current year and articles that relate to the next year. And also Joe has to make some balance sheet reservations for something that relates to the next year, but not stuff that relates to the current year. So most places now, and the DOR is the preferred method for them, is that they break their annual town meeting and go into a special town meeting, hold a special town meeting, and then it becomes two separate votes, and it just looks cleaner on the recap sheet, and that's the way I think everybody used to do it your way.
We've already decided that that's what we're gonna do.
Yeah. Okay. Then I won't say any more.
We read your letter a couple weeks ago.
Okay. And the next comment has to do with the stabilization fund, the solid waste one. You also have your regular stabilization fund, and you have a separate general ledger account and a separate investment vehicle, and the two of them are supposed to equal. And it's the same thing with this. Joe established a separate stabilization ledger account, and the interest is supposed to accrue to it, and that's typically why they set up a separate investment vehicle, so it can just flow into it a little easier and not have to allocate the interest. But there was no separate bank account established for it or investment vehicle established for it, and I don't believe the interest accrued to it during the first year. So I just recommend that you establish a new bank account or investment vehicle
So,
of any type.
at our October town meeting, we created an additional stabilization fund that we're calling debt stabilization.
Yep.
And this is where we've taken, money that we've gotten from the 40R, the Berry project, and we're putting it in there to stabilize our, non-exempt, debt service going forward. So we do the same thing there?
Yep, separate investment vehicle. Because the interest is supposed to accrue to it. That's it on the management letter. There's actually, in the management letters now, there's three types of comments. There's material weakness, significant deficiencies, and control deficiencies. And all of the material weakness being the worst, significant, and then control. And you have nothing that's considered a material weakness or a significant deficiency in here. These are all just what we consider control deficiencies. So, I mean, it's not, these are the least critical of. The financial statements, I don't know how much you want me to get into them, but I do want to just say a couple things about, there's an opinion letter on the financial statements on page 1, and it's a clean opinion. It says the financial statements as presented are correct in all material ways. And there's one paragraph, the third paragraph, and that's what the Moody's and the lenders will look at before they even open up the financial statements to look to make sure that there are no qualifications or that it's a clean opinion. We're also required on page 44 and 46 to issue a couple other opinions or reports, and they're on internal controls and compliance with laws and regulations for the town, and also for grants, a similar report for grants. And those are on page 44 and page 46, and both of those are clean opinions also, so there were no findings on the grants or on town with compliance with laws and regulations. One other report I'd like to just show you is page 41, and most of the statements in here, there's a lot of accrual entries, and there's not much budget basis information in there. There's some good reports, but this is the one that I think that really relates most to your budget picture, and it shows how you generate your free cash. If you look at the top part, it has the original budget, the final budget, and then your actual amount. And the far right column shows whether you have a variance, positive or negative. And this is what generates your free cash. As your revenues, if your revenues come in over budget, then you created $540 worth of free cash from your revenue side. And your expenditure side, when your expenditures come in, expenditures and encumbrances come in under budget, you create free cash. Now, if you go down under the expenditures, it says $74,596, but where there's a negative in highway of $122,000, 158 of that is a snow and ice deficit. So you really had positives. So, and you raised that on the recap sheet. So you really raised your expenditure side. You really had 170. You had 74 plus that 158 that you really turned back and generated in free cash. So you're doing good with your revenue estimates in order to generate free cash. It's difficult to be conservative, but it's a lot easier to give out money when you have free cash than to try to build up free cash afterwards. I'd be glad to go over as much. If anybody had any questions of financial statements, I know they've got plenty of other things to do, but if anybody wants to take time at another time, I'd be glad to sit down with them and go over it. Or if you have any questions on financial statements as they stand right now, I'd be glad to go over them in any detail.
Mr. Chairman,
Yes, Mr. O'Leary.
Dick, just in relation to some contingent liabilities, you mentioned the Cops Fast grant.
Yeah.
Specifically, and then you mentioned the non-specific, a couple of other ones. I don't know what they have. Do you take a look at town meeting actions to see if it creates any contingent liabilities for us, or do you just rely upon our finance department to identify them?
Well, no, we send out a legal letter to your legal firm, and we do look at town meeting votes, but to be honest with you, I can't tell you of any that in my experience that I've seen that town meeting votes that create a contingent liability.
I'm thinking about the Eisenhower Park acquisition.
Well, that
which obviously-
is addressed in here.
Yeah.
And that's what we got the number from, was the one of the contingent liabilities was
that's one of the reasons why I